Since it went public, Old Dominion Freight Line has nearly 500,000% returns to shareholders. $1 invested in Old Dominion in the early 1990s is almost worth $500 today. With huge returns, has Old Dominion run out of room to keep growing? Well, Chris Mayer, the author of the book 100 Beggars, doesn't seem to think so. Since opening his fund in 2019, Old Dominion makes up just one of 10 positions in his portfolio. With this high concentration, he seems to think the business has room to run. Might he be right? Analyzing Old Dominion Freight Line, stock ticker ODFL, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Old Dominion. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Old Dominion for your portfolio to see if it's on sale. Before we get into these valuable metrics, let's understand Old Dominion stock performance. Right now, Old Dominion trades for $311.64 per share. In the last year, their stock price is up 15%. This crushes the S&P 500. In the last 5 years, they're compounding at 26% annually, again crushing the index. In the last 10 years, this is the same story. Old Dominion is compounding at 27.5% annually. Going back prior to the global financial crisis, in the last 18 years, Old Dominion stock price is compounding at 23% annually. The company also pays out dividends. Right now, Old Dominion pays a 0.4% dividend yield. Their average dividend yield throughout this time is in addition to these compounded annual returns. Old Dominion is trading $70 below their 52-week high. The company is up $80 from their 52-week low, so they're right in the middle. 4% of their shares are sold short. Old Dominion's a large business. They have a $35 billion market cap. Why may Old Dominion have room to keep growing? Old Dominion Freight Line is the second largest less-than-truckload carrier in the United States, with more than 250 service centers and 11,000 plus tractors. It is by far one of the most disciplined and efficient providers in the trucking industry, and its profitability and capital returns stand head and shoulders above its peers. Strategic initiatives revolve around increasing network density through market share gains and maintaining industry-leading service via steadfast infrastructure investment. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. This is because the average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock's likely to return approximately what its underlying business returns. These business returns are captured here by return on capital. Looking for a benchmark allows us to build in margin of safety based off the overall quality of the business being about twice as good as average. Old Dominion earns very high returns on capital in all 5 of these years. Their returns on capital have steadily grown since 2019. They earned 44% returns in their most recent fiscal year. Averaged out in the last 5 years, Old Dominion earns about 30.5% average returns on capital. These returns are 4 times better than a typical business. This is a very big check on metric number 1. Metric number 2, we're looking at their high-level growth. We want to see growth in their revenues, net incomes, and free cash flows in the last 5 years. This metric's all or nothing. All 3 of these have to be up for this to be a check. During this time, Old Dominion has grown their revenues by 53%. Their earnings have more than doubled, and their free cash flows have almost tripled. With large growth across the board for Old Dominion, this is a check on metric number 3. It's great to see their free cash flows leading their growth. Free cash flow is the lifeblood of any business. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later in our video to estimate Old Dominion's fair intrinsic value, so wait for that. Metric number 3, by taking the perspective of an individual shareholder in Old Dominion, we're looking for earnings per share growth. During this time, we've learned Old Dominion has more than doubled their earnings. In the last 5 years, Old Dominion has also bought back 9% of their shares outstanding. This is important as a long-term shareholder in the business because when you purchase a share of stock, what you're really buying is a fractional ownership percentage. When a company buys back stock by decreasing the number of shares they have outstanding, they're increasing your ownership percentage, which increases the percentage of the company's profits you're entitled to without you having to spend a dime. Like any other acquisition, we want the business to be getting more value than the price they're paying. This depends on a couple of factors, including the price these buybacks occurred at, and again, what a fair intrinsic value for the company would be. With their strong earnings growth and their share buybacks, this is a check on metric number 3. We're perfect for Old Dominion so far. Metric number 4, we're looking for cash flow per share growth in the last 5 years for Old Dominion. Their cash flows have almost tripled over this time, and with their 9% share buybacks, this is another very large check on metric number 4. Old Dominion is still perfect through 4 metrics. Will they keep this going? But there's still one vital piece missing. You might think nailing high returns and having strong growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. Metric number 5, we want Old Dominion's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the company has produced in their last 5 years. Old Dominion has had negative net debt in all 5 of these years, meaning after paying off their debt, they're left over with cash. Right now, the company would be left over with $130 million in cash. In the last 5 years, Old Dominion has had strong free cash flows that they've almost tripled throughout this time frame. With both a cash cushion and strong cash generation from the company, this is another great check on metric number 5. We're perfect through our first 5 metrics. Does Old Dominion have what it takes to be a Select 6 stock? We'll find out right after covering our bonus. As our bonus, we're looking at Old Dominion's dividend profile. Right now, Old Dominion pays a modest 0.4% dividend yield. We're looking to see that the company supports their dividends with their cash flows, which they've done in all 5 of the last years. Old Dominion has nearly quadrupled their dividend payouts. With reliable free cash flow generation and a healthy balance sheet, Old Dominion has easily supported their dividend payouts. With their big increases in their dividend, it looks like Old Dominion could be a dividend growth stock for a long time to come into the future. Keep in mind that this is a snapshot of their last 5 years of performance, and it's no guarantee. Old Dominion's dividends are looking healthy and sustainable here. The big metric of them all, metric number 6, we want Old Dominion's average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this provides a slight risk premium to the yield of the 10-year treasury. It may provide a reasonable starting point for a valuation of Old Dominion as well. Old Dominion currently has a $35 billion total enterprise value. This takes into account both their market cap and their net debt position. In their last 5 years, we learned the company produced $3.1 billion in free cash flow, meaning in an average year, Old Dominion produces about $620 million worth of free cash flow. When we divide those free cash flows by their enterprise value, that gives about a 1.8% average free cash flow to enterprise value yield. On a current basis, Old Dominion produced $917 million worth of free cash flow in their most recent fiscal year. When that's divided by their nearly $35 billion total enterprise value, that gives about a 2.6% current free cash flow to enterprise value yield. Both of those are coming in below the yield of the 10-year treasury and below that risk premium, meaning all the way at the end here, this is our first and only X of the day on Old Dominion, but we're not done yet. Stick around as we come to a more concrete estimate of Old Dominion's fair intrinsic value before giving our final rating to the business. You don't want to toss this business out, as this analysis is not financial advice and it's not a buy or sell recommendation of any security. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Old Dominion, which takes us on to using a discounted cash flow model to come to an estimate of Old Dominion's fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. Old Dominion's been a very predictable business in its past. Like any model in any discipline, a DCF's model's outputs are sensitive to its inputs. We're starting with an average of Old Dominion's free cash flows in their last 5 years, then using historical growth assumptions to grow these into the future. It's up to you to do your own homework to figure out if these are accurate and applicable for the business. Assuming Old Dominion grows their average free cash flows at a rate of over 11% annually for the next 10 years, then assuming these grow at 5% for the 10 years from there, if we add in the company's tangible book value, which gives us an estimate of their net worth, and if we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, in addition to his margin of safety requirements, from today's valuations, an estimate of Old Dominion's fair intrinsic value is only around $115 per share. Their current stock price would be cut by more than half to hit this fair value. Keep in mind some key points. Old Dominion's business has been very predictable in its past. That's not a guarantee for the future. The trucking and logistics industry can be somewhat cyclical in nature, so that could also affect these assumptions here. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before considering an investment decision. In just a minute, we'll give our rating to Old Dominion, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, it's expected Old Dominion's operational performance will continue to handily outperform its less than truckload peers in the years ahead on the back of unrivaled operational execution and diligent network investment. Number 2, over the past decade, Old Dominion more than doubled its less than truckload market share thanks to steady investment in capacity and network service capabilities, including an impressive cargo claims record. Number 3, despite near-term normalization off highs, e-commerce growth should provide incremental demand tailwinds for less than truckload carriers over the long term, with more frequent yet smaller shipments. Then the key factors supporting a potential short thesis. Number 1, Old Dominion's less than truckload trucking operations are capital intensive, and its vast network of terminals and distribution centers creates a sizable fixed cost base that amplifies cyclicality. Number 2, its expected less than truckload industry yields will normalize in 2023 on muted demand, more readily available capacity, and easing fuel surcharges. Number 3, industrial end markets are slowing and retail sector demand has cooled as the inventory restocking boom fades. Thus, Old Dominion's freight volume will likely see pressure through the first half of 2023. There you have it for a balanced perspective of some of the qualitative aspects of the business. Now it's time to give our rating. In analyzing Old Dominion Freight Line, stock ticker ODFL, we learned the business earns very high returns on capital of more than 30% in a given year. Those are 4 times better than average. In the last 5 years, not only has Old Dominion bought back 9% of their shares, they've strongly grown their revenues, earnings, and free cash flows, experiencing operating leverage as their free cash flows and earnings have led this growth charge. The company has over $100 million in cash left over after paying off their debt. They've been highly cash flow generative in all 5 of the last years, growing these free cash flows throughout. On both a current and an average basis of their free cash flow to their enterprise value yield, those yields were below the yield of the 10-year treasury. However, Old Dominion has supported aggressively growing their dividend in the last 5 years, maintaining a very healthy dividend payout ratio and sustaining these with their free cash flows in all 5 years. It would seem like the business has plenty of room to keep growing their dividend well into the future. Combining the factors of our analysis, Old Dominion looks like a very strong candidate for further research. Performing our discounted cash flow model, if you've done the work and you believe those historical growth assumptions, if you are seeking a 15% rate of return from today's valuations, an estimate of Old Dominion Freight Line's fair intrinsic value is around $115 per share. The company was last at those levels during its March of 2020 lows. Be patient as you research this business. As a past nearly 500 bagger, does Old Dominion have what it takes to be a future 100 bagger? Maybe. It has very strong fundamentals, but its price multiples may have gotten ahead of themselves. Still, this is a great business to dig in and learn more about. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Old Dominion with me, and have a great day.